Hey Bowtie Nation, Joseph Hogue here with your weekly stock market update, 9 a.m. Eastern every Monday morning with the stocks to watch and the stock market news you need to see. And Nation, if you could buy just one stock in 2026, it should be the one sitting at the center of the biggest financial shift in decades. More than AI, robotics, more than cybersecurity, this investment is my top pick this year for return. I'm going to show you why I'm investing over $1.5 million and the easiest way to invest. Stick around and I'll update our stock market outlook for 2026 along with a review of the 8 biggest holdings in my own portfolio, including SMCI, SoundHound, Symbotic, and SoFi Technologies. First to that top stock to buy though, and folks, artificial intelligence, cybersecurity, robotics, it is all coming over the next few years and is unstoppable. These are the growth themes that you need to be buying for returns, but there is another theme above all these others, my top investment for 2026. Those of you in the nation know I've been loading up on Ethereum ETF since June, now with over $810,000 invested, and I'm buying more monthly to a $1.5 million target through the first half of this year. The price of Ether, the cryptocurrency used in transactions and computing on that Ethereum network, closed down 12% last year, but is about to have its best year ever. This is the year the token is going to be validated as the future of finance, but I know a lot of you out there are still skeptical, so I want to prove it out before all this happens. Give you one last warning to invest. Understand first, I'm not going to be making any price predictions. You see these all over the internet. Ethereum to 60,000 and Bitcoin to a million. But it's all bullshit. That's because unlike stocks, which can be valued on profits of the company they represent, or bonds priced off interest rates and that credit quality, there is just no way to fundamentally value an asset like cryptocurrency. It's the reason I stayed on the sidelines for so long because that price of a Bitcoin or an Ether is only worth as much as someone else is going to pay you for it. And there is no way to model that in a spreadsheet or forecast it on fundamentals. And yes, I know that doesn't stop every crypto bro and their mother from forecasting prices. They look for patterns in the price, use archaic mathematical relationships like Fibonacci, basically anything and everything just to make sense of that price or to predict the future. Like Nostradamus, though, they leave those predictions just vague enough that they can wiggle out of them with an excuse later. And I get it, though. As investors, we want to look for some kind of certainty, a way to value an investment and say, hey, I'm getting a great deal here. But it just does not work with a commodity that produces nothing on which to value it. All those predictions, the forecasts for the price are more marketing than real analysis here, folks, and just another way to get your valuable internet attention. But there is something more important than those price predictions, a reason I'm building to that $1.5 million investment. That something taking Ethereum to this year's best investment is the unstoppable direction of finance with the power of trillions of dollars behind it. I want to start with an article here arguing that both Ethereum and Solana can be winners in this trend. Not because I think there's a contest for Solana here, but because it offers the best explanation of tokenization and really the driving force behind all of this. It starts out here with think of tokenization as turning real world stuff like US treasuries, stocks, or real estate into digital receipts on a blockchain that you can trade 24/7. And if you think about that, it is very similar to buying a stock. You are buying a fractional ownership of a company's profits and represented by a digital record with your broker. It's the same thing with tokenization. And the custodian puts an asset, let's say an apartment building, into a legal holding company, then creates a digital token to represent that fractional ownership in the asset. Instead of having to shell out millions of dollars for the property, investors can buy a single token and have that ownership right to the property and all its cash flows. And I know you're asking yourself, but if we already have stocks for company investments, REITs for real estate, and other assets, why do we need tokenization? Why is finance about to change like this? Here, Bitmine lays it out with 5 key reasons, benefits to putting assets on the blockchain through that tokenization process. First, that fractional ownership makes it easy for anyone to invest, even if the asset would otherwise cost thousands or even millions to buy outright. Benefits especially relevant to real estate are the enhanced transparency and liquidity. When you buy a house, title insurance can cost up to 1%, thousands of dollars for insurance just to make sure that you're buying the house from the true owner. Through tokenization, the blockchain ledger is always going to show exactly who owns that asset. Also, instead of having to wait to find a buyer for that asset, something that can take months for real estate, you can start selling your share of the asset, the tokens you own, immediately. Then, reduced cost and 24/7 trading are really the biggest benefits here. Selling a tokenized asset on the blockchain is instantaneous and a fraction of the cost compared to traditional transfers like wires or bank transfers. Even a stock trade, while seemingly instant, actually takes 1 or 2 business days to clear. On these benefits, we've already started to see that shift in the direction of finance. The market value of tokenized stocks surged 2,500% last year to over $800 million. Robinhood offers almost 2,000 tokenized stocks, mostly US stocks that can be bought or sold 24/7 by foreign investors, those without that access to the US markets. NASDAQ, which sees over $6 billion in stock trading every day, wants to be next and has filed with the SEC to tokenize stocks on its exchange. And the London Stock Exchange Group has also started its own project. Just last month, JP Morgan announced it had started tokenizing its money market funds on the Ethereum network. The world's largest bank seeded the fund with over $100 million of its own money and is opening it up to investors. This has the potential to put the $7.7 trillion money market onto the blockchain, a move that would see all the benefits of that tokenization plus a higher yield through staking. And earlier in the year, the SWIFT network, a network of over 11,000 banks and financial companies that manage wire and international transfers, said it would be creating a stablecoin, a kind of tokenization, to enable real-time 24/7 cross-border payments at a fraction of the cost. That is a market of $7.5 trillion in daily transfers. I'll explain how all this drives the price of Ethereum, but as Bitmine says in this presentation, this is truly the network's ChatGPT moment, a turning point where use cases become an inflection in history. All this means is, nation, you do not need a price prediction. If even a fraction of the $7 trillion money market, the $7.5 trillion SWIFT transfers market, the $37 trillion global commercial real estate market, or the $127 trillion global stock market, just a fraction of this means trillions of dollars in assets moving onto the blockchain, increasing demand for the Ethereum network. Every transaction there, whether it's trading a tokenized stock, moving stablecoins in a money transfer, or changing ownership of an asset, all of this requires ETH to pay gas fees or that compensation to change the digital ledger. At the same time, Ethereum is burning a portion of those fees, reducing the total supply of Ether. So here you get a double effect, rise in demand for the cryptocurrency and then shrinking supply, all driving that price of the token higher. While there are some out there that would like to think that other altcoins have a chance, that maybe others like Solana will rise as its network is used, this force is all about Ethereum. The major banks and the institutions, they're all building their projects on the Ethereum network. That network effect reinforces Ethereum's stronger liquidity and safety, ensuring that the race to tokenization is going to continue on its network. More than 2/3 of the total value locked in decentralized assets is in Ethereum, so while you could make the case for holding some Solana as well, the investment here is clearly in Ether. And again, I'm not going to put a price prediction on this because there's just no model or direct correlation you can use with volume and price. But you really don't need one, do you? Those trillions of dollars are coming onto the blockchain. With just $356 billion in Ethereum right now, about 120 million tokens, that is going to be an increase by orders of magnitude higher. That may not mean we get to Tom Lee's Rainbows and Unicorns prediction of $62,000, which would be a 30 times return, but even a $9,000 Ethereum would be 3 times your money here. I started buying the Grayscale Ethereum Mini Trust, the ETH, in May at around $24 per share. Since then, I've switched to buying the iShares Ethereum ETF, the ETHA, and have just over $800,000 in the two funds. Now, both funds hold Ethereum futures, and charting them out here, you can see that both track the price of Ether exactly. The reason why I switched is because the ETHA has more volume and better liquidity, and so more options available with smaller spreads. And that's also one of the first reasons why I prefer buying these Ethereum ETFs instead of just buying the crypto directly on a platform like Coinbase. With the ETFs, I can use options investing to not just create income or increase return, but also to lower my risk. It's also about safety though. Buying those ETFs in my brokerage accounts, I never have to worry about losing my crypto password or wallet storage. Hell, one man has been searching his local landfill for more than a decade to find a hard drive storing more than $750 million in Bitcoin. With those ETFs, you don't have to worry about hackers, scams, or even IRL thieves breaking into your home to steal your crypto. I'm planning on building up that position in the ETHA fund over the next 3 months of this year at least. And that gives me a position now, but also holds money back if we get one more dip in the price before tokenization really takes off. And again, here, the biggest reason why I'm using those ETFs instead of buying Ethereum directly is the premium on these options. Because of the volatility of the asset class, so many ups and downs, these premiums are just too good to pass up. For example, I can go here to the options that expire January 2027, about 1 year from now, use the wheel strategy to create instant income, or just use the covered call strategy to create income and lower my risk. Buying the stock here at $23.58 each, I can collect $4.92 in cash just by selling the $30 call options on each share. Now that means I sell to another investor the right to buy those shares from me for $30 from now until January in exchange for that $4.92 per share payment. And if you've never used options before, think about what this means. Collecting that money, I effectively lowered my cost from $23.58 by $4.92 to a cost basis of just $18.66 per share. That is a 20% discount to the current price. If the shares go to that $30 each by next January, I will make a 60% return in 1 year. If they stay under $30, I keep the $4.92 collected, basically making that 20% cash return, and I still keep the stock. Now, I know options can be confusing, but if you aren't using these investments, you are missing out on an opportunity not just to create that income, but to boost returns and even lower your risk. To help you get started, I'm relaunching our Ultimate Options course. Over 3 hours of video, I start with the basics and then walk you through 29 option strategies, when to use each, and how to set it up, including a real-world example with shares of Tesla. The course also comes with a one-of-a-kind strategy finder to help you find the right option strategy and an options calculator to show you exactly how much money you can make. Right now, I'm relaunching the course at a 38% discount. Save $150 off, but only for the next 3 days. You're going to get all the basics to get you started, the strategy finder to make sure you're using the best strategy, the options calculator to show you exactly how much you can make, walkthroughs on all 29 strategies, and a 14-day money-back guarantee. Now, that $150 launch discount is only available with the coupon code I'll leave in the description below, so look for that link or scan the QR code here. Rather than talking about the stocks to watch this week, I wanted to give you an update on some of the stocks that we've talked most about here on the channel and my biggest holdings in my portfolio. And that starts off with Super Microcomputer, ticker SMCI, was on a roller coaster last year and is likely to do it again this year. The leading server maker was up as high as $66 in July, but crashed hard into the end of the year. Revenue is still expected to pop 65% in fiscal 2026 and another 22% growth next year to $44 billion. But the problem here is earnings, with per share profit flat from last year as that price competition in data center servers eats away at that profitability. I'm holding on to my 26,000 shares, and the February earnings report could be a strong upside catalyst. Disappointing sales last quarter were on a delay in orders to this quarter, with analysts expecting sales growth of 82% when the company reports. Earnings per share is expected to be lower and is going to be a big focal point, but this stock is still in deep value territory at just 0.5 times on a price to sales basis and should be back over $40 or $50 a share very soon. Advanced Micro Devices, ticker AMD, is up 95% from where we started buying February of last year, even after selling off with the rest of AI in November. CEO Lisa Su is confident the company can produce 35% annual growth for the next few years, which means the stock isn't particularly expensive here at about 10 times price on this year's sales, but it's also not the super cheap valuation of 6 times when we started buying last year. I'm holding on to my shares, but really not excited about buying more just yet. Symbotic, ticker SYM, is another big winner here, up 144% since we started adding those shares. I continue to believe the company is going to revolutionize warehouse robotics and can leverage its partnership with both Walmart and SoftBank to get there. But the lack of any new deals or recent news does worry me here. The shares aren't expensive at 2.8 times price to sales for a company growing at 20% plus a year, so it's still a good value, but I would hold some money back after earnings in early February just in case we get a dip. And SoundHound AI, ticker SOUN, was up as high as 360% from the $4.75 a share we started buying at in February 2024, but has since come down to just over $10 a share, still double that original price. And we've seen this story before though, with the stock spiking past $20 in January of last year, only to drop past 10, then rally up again. Revenue doubled last year and is expected up almost 40% this year as the company dominates in that voice AI assistant market. Now I'm using it as a second chance to load up on more shares here before it turns into $20 stock again. The cybersecurity stocks, Fortinet, ticker FTNT, CrowdStrike Holdings, CRWD, Zscaler, ticker ZS, Palo Alto Networks, ticker PANW, and Okta, ticker OKTA, had a mixed year with most of our positions up, but not by much. CrowdStrike Holdings and Zscaler continue to prove themselves really the growth picks of that group. Okta is the value name here, but hasn't gotten the takeover bid I'm watching for, and Palo Alto and Fortinet closed lower on the year. But folks, these are the leaders in one of my favorite growth themes there, only second to Ethereum's tokenization push. It might not have the growth of AI, but cybersecurity spending is increasing at a 12% annual pace and is one part of the IT spending chain that cannot be cut. Because of that, I'll continue to add to these stocks regularly each month. Shares of Ally Financial, ticker ALLY, are up 27% from where we started buying early last year. Now, I started buying Ally when our other fintech favorite, their SoFi Technologies, SOFI, started getting too expensive. Ally was trading at 0.9 times on that price to book basis. That's cheap compared to SoFi with its price of 4 times book value. Shares are now trading for 1.1 times book, well above where investors have been willing to pay in the past, and that revenue growth just isn't there to justify much more, so I'm going to be taking my profits on Ally. Then there was the trade desk, ticker TTD. It was the biggest disappointment on our portfolio last year and the worst stock in the S&P 500, down 67% on the year. Now, I did update in a video in November selling the stock to tax harvest the losses against other gains, but I wanted to update you here as well, just in case you didn't see that. Earnings are out mid-February, and I might buy some call options ahead of that report. Now, last quarter earnings and the outlook wasn't that bad, and there is a good chance that we get a big relief rally if management can prove that competition from Amazon isn't destroying those sales as investors fear. And then SoFi Technologies, ticker SOFI, is another one that I've pulled back on as it reached that $30 in late last year. The fintech bank still books the best growth in the industry, with 25% revenue growth expected this year, which is unheard of in banking. But I'm just not comfortable paying 4 times price to book value for a bank stock. Shares are up 288% from where we started buying it in 2022, from just under $7 a share. It's still growing into that mega bank that I know it can be, but I'd rather wait for a bigger dip to be more confident on the price here. Updating our stock market outlook. Bad news might be good news this week with the monthly jobs report released on Friday. The December survey is expected to show just 54,000 jobs were added during the month, below the 64,000 added in November and well below the number of new jobs economists believe marks a healthy labor market. Along with this weakness, the unemployment rate is expected to rise to 4.7%, which would be the highest since September 2021. While all of this speaks to a struggling jobs market that could affect consumer spending, it's also going to be just reason for the Fed to continue cutting rates. Investors aren't expecting another rate cut by the Fed until April, and then only one more in July, according to the FedWatch rate tool. That long wait for lower interest rates takes another leg of support from stocks, but a weakening jobs market could convince the Fed to act sooner, a welcome surprise for the market. So far, what is being called a K-shaped recovery is keeping that economic growth positive and corporate earnings healthy, all of which are supporting the stock market. This is where groups of the economy bifurcate or separate, some doing well and continuing to spend, while others get left behind. Strong stock returns and home prices have helped investors, the affluent, and homeowners, while inflation has hit consumers in other groups. So not only would a weakening jobs market put another rate cut on the table this year, something that would definitely help support stocks and the economy, I continue to believe that political pressure is going to push the Fed to move more directly on long-term interest rates, probably through buying mortgage bonds later in the year. And that could recharge the housing market, unlock trillions of dollars in home equity, and drive this bull market into its fourth year. Get your $150 discount and learn how to use options to boost returns, create income, and lower your risk with the course linked in the description. You're going to get the options calculator, the strategy finder, and everything you need, including a 14-day money-back guarantee. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.